So let's begin with our big issue. No quick fix for U.S. China trade issues.
The reality is that it's a long game.
Long game.
Long game.
Disrupting entire kind of economies takes time.
That doesn't get solved over tea.
We know that this is not just about trade. It's about an overall rivalry between the two nations.
We're either going to work as complementary economies or we're going to try to crush each other.
It's extremely narrow to think about a U.S. China conflict as just a U.S. China conflict. It's going to be something with global implications.
This trade war is now getting a bit more serious.
The problem is that the cost of achieving lower trade barriers by initiating the negotiation process with tariffs is that by the time you get that positive outcome, if you get it, you'll be at a much weaker level of the global economy.
This next stage of the trade war gets a little bit more painful and a little bit more visible.
Joining us around the table to discuss now, Weisberger of AB Bernstein, Jonathan Golub of Credit Suisse, and Bloomberg's Lisa Abramowicz. Lisa, do you get the feeling this gets worse before it gets better?
I mean, certainly that's the rhetoric from this morning, and certainly that's what the market is kind of waking up to, it seems like somewhat suddenly. And I think that the big question is, you know, could we end up with some kind of major escalation? There's some talk now about China actually targeting agricultural goods. They already said that they are going to increase tariffs on about 2,500 additional goods in the United States to 25%. I mean, clearly right now, it doesn't seem like there's a resolution on the near.
The news, higher tariffs, the speculation coming from the Global Times that maybe they pull back on US ags, maybe they reduce Boeing imports as well. John, on a morning like this morning with futures down 2%, very difficult to distinguish between noise and news. What do you tell clients this morning?
Well, first of all, I thought the clips that you guys picked were the right clips, because what I was expecting to see was this real short-termism that, oh, the markets are off because of this news and you want to play it. And I think there's a right way to look at it. We don't have access to the Chinese market. They are taking advantage of intellectual property issues. It's not only the U.S., because everybody else wants to sell into their markets and are basically getting a bad deal. And if we get the right deal out of this, it actually is a pro-growth trade effort. The problem is that there needs to be a little bit of scorched earth in the process, and we're going through that. But I'm not pessimistic that this thing isn't worth the fight. But 2 weeks ago, we didn't expect to see any of this.
What do you think, Noah?
I think, a couple of issues here. One is that, the market may be the forcing function once again, which is to get policymakers back to the table. It's going to be some pain, and that pain is both economic and from a market perspective. But in the near term, I think we've tried to pull a little bit closer to benchmark, and I think part of that is the fact that the market seemed vulnerable to us even before this happened, and some of the leadership beneath the index we thought was, baking in a lot of optimism on China, and we just didn't have any visibility there.